Chapter 1: The Retail Trap. The Misconception. Welcome to Episode 3. Up to this point in our Masterclass series, we have audited the P&L statement and mapped the balance sheet perimeter. But if you stop there, your capital is highly vulnerable. Many investors assume that a highly profitable top and bottom line on the P&L means the business is flourishing. They read a positive net income figure and believe cash is flowing effortlessly into corporate bank accounts. This is the ultimate retail trap. The P&L statement operates under accrual accounting mechanics, recording revenues and expenses when transactions are finalized, not necessarily when cash changes hands. A company can report magnificent revenue growth and record-breaking paper profits while quietly suffocating from a lack of liquidity. Imagine a company sells 100 crore rupees of goods on credit. The P&L records revenue immediately, but if customers haven't paid yet, the cash hasn't arrived. If you want one of the strongest defenses against creative accounting or corporate stress, you must stop looking exclusively at accounting earnings and start tracking physical cash. Chapter 2: The Institutional Mechanics. The Real Concept. To follow the money like an institutional investor, you must master the statement of cash flows. This document reconciles accounting earnings with actual cash movement through the business. The cash flow statement is generally harder to manipulate than reported earnings because it tracks actual cash movement, reducing the influence of management estimates. The statement addresses three core operational questions. What cash did the core operations generate? Where was capital reinvested to preserve or expand the trajectory of the firm? And how much cash was raised from or returned to capital allocators? Every financial movement a corporation makes is systematically classified into three business activity baskets. First, cash flow from operating activities, or OA. This is the primary engine of the firm. It tracks cash generated or consumed by daily core operations, including manufacturing, inventory turn, and customer or vendor settlements. Second, cash flow from investing activities, or IA. This tracks long-term capital deployment. It shows cash spent on or received from parking money in treasury instruments, buying machinery, or purchasing non-current assets. Third, cash flow from financing activities, or FA. This maps how the firm manages its capital structure perimeter. It tracks cash transactions like issuing fresh share capital, raising new debt, and returning capital through dividends. The net cash flow is simply the mathematical sum of these three components. Chapter 3: The Surgical Audit. How to read it. We will now execute a surgical cash audit using the unedited financial ledger tables of Amara Raja Batteries Limited, or ARBL, for the financial year ending March 31st, 2014. To maintain perfect, seamless alignment with the local ledger tables displayed on your screen, the line items are evaluated directly in million rupees. Open the statement and focus entirely on the Operating Activities section first. We start with the profit before tax of 5,366.70 million rupees as our anchor, but profit is not cash. The entire purpose of this section is to reconcile accounting earnings with actual cash generated by the business. The first category of adjustments deals with non-cash expenses. Depreciation of 636.69 million rupees and amortization of 11.04 million rupees reduced reported profit during the year, yet no physical cash left the company when those accounting charges were recorded. These are therefore added back. The second category reverses non-operating income and gains that do not belong under operating activities. Interest received, dividend income, and gains from the sale of fixed assets all increase accounting profit. But the actual cash related to these items will be tracked separately under investing activities. To avoid double counting, they are removed from the operating section. The third category captures accounting provisions and adjustments. Items such as bad debts warranty provisions, gratuity provisions, leave encashment provisions, asset write-offs, and similar accounting entries affect reported profit, but do not necessarily represent immediate operating cash movements. The cash flow statement adjusts for these items to isolate the true cash generated by the business. After applying all of these reconciliation adjustments, we arrive at operating profit before working capital changes of 5,709.18 million rupees. Now we move to the working capital adjustments, which track how day-to-day business operations consume or release cash. During the year, inventories increased by 421.50 million rupees. This means additional cash was tied up in stock sitting inside warehouses. Trade receivables increased by 711.71 million rupees, indicating that more revenue was booked on credit without immediate cash collection. Loans and advances also increased by 445.72 million rupees, creating another drain on liquidity. Further, trade payables decreased by 77.73 million rupees, reflecting money paid by the company to settle past debts to their suppliers. Some of this cash absorption was offset by an increase in other current liabilities of 341.23 million rupees, which effectively delayed certain cash outflows. After combining all working capital movements, the business experienced a substantial cash absorption from operating assets and liabilities. Even after these working capital demands, the company generated 4,393.75 million rupees of cash from operations. Finally, after paying 1,606.25 million rupees towards income tax and wealth tax obligations, the net cash from operating activities stood at a healthy positive 2,787.50 million rupees. Next, audit the investing activities basket to see where management deployed that wealth. ARBL spent a massive 3,313.96 million rupees on the purchase of fixed assets to aggressively expand factory capacity. After offsetting this with minor cash inflows from current investment sales and dividend receipts, the net cash used in investing activities stands at exactly negative 3,448.42 million rupees. Finally, track the financing activities section. This maps how the firm balances its capital liabilities. Between servicing interest costs, managing short-term borrowings, and distributing dividends to equity shareholders, the net cash used in financing activities stands at a negative 531.00 million rupees. Now execute the cash continuity verification. Sum up the operating, investing, and financing nets. 278.75 minus 344.84 minus 53.10 yields a total net cash decrease of exactly 119.19 crore rupees for the financial year. This ledger ties out perfectly with the physical cash movement on the balance sheet, verifying the absolute truth of the transaction cycle. Chapter 4. The Weaponised Application. Red flags and trade-offs. You now possess the institutional framework. Let us apply these mechanics to isolate deep operational risks and find the structural delta between paper wealth and real liquidity. First, calculate the divergence metric by comparing net profit after tax directly against the cash flow from operating activities. Over long periods, operating cash flow should broadly track reported earnings. If a company consistently reports spectacular net profits, but its operating cash flow is persistently negative or stagnant at zero, it demands intense scrutiny. It can indicate aggressive revenue recognition, or that paper profits are trapped inside uncollectible receivables and deteriorating inventory. This variance is where you spot structural decay. Second, analyze the relationship between operating cash and investing cash to identify the funding mix. A firm that generates 2,787.50 million rupees from operations and confidently sinks 3,448.42 million rupees back into capital expenditure is running an aggressive, self-sustaining growth cycle funded largely by its core business. However, if a company shows massive investing outflows while operating cash flow is deeply negative, and props up the entire system through a spike in financing cash inflows from constantly issuing new stock or taking on fresh debt, it tells you the business is surviving on outside oxygen rather than core operational viability. This mismatch exposes an unsustainable arbitrage between reported growth and structural cash burn. Strip away the adjustments, ignore the narrative commentary, and track the hard cash. Only then can you see the authentic pulse of the enterprise.